Welcome to lesson 1, part 7, where we are going to talk about diversification. In the previous videos under lesson 1, we have discussed the 3 different types of stocks and their corresponding sectors. Remember, we spoke about defensive, cyclical, and moderately cyclical stocks. I explained the nature and characteristics of these stocks and their sectors. I further broke things down and taught you the 8 stock investing categories one can choose from when constructing a portfolio of companies. You may ask yourself, what is the reason for going through this material in such great detail? It is simple. It is so that we can diversify our money across these various sectors and categories. In other words, we do not want to put our money in one basket, but instead we spread it evenly across several baskets. But why do we do this? It is because no matter how good an analyst you are, or no matter how great a company is, as retail investors, we cannot put all our eggs in one basket. Why? Because life happens. Great giant companies sometimes fail due to circumstances beyond our control, circumstances that we could not have foreseen. Take, for example, the collapse of Steinhoff. A lot of people had all their money invested in this business, and when it collapsed catastrophically. These people lost a lot of money. Another example is Alibaba. Due to government regulations and crackdown 2 to 3 years ago, this stock price of Alibaba has dropped by over 67% from all-time highs. This is despite Alibaba remaining a great and profitable business. Imagine if you had put all your money into Alibaba, you would have been losing money for the last 2 to 3 years. Now, even though I believe the stock price of Alibaba will eventually recover, but it may take several years, and that is a situation we do not want to be in as investors. We want to be able to make money and grow our portfolio every single year. That is why diversification is key to successful investing as retail investors. Remember, as retail investors, we invest as outsiders and not as insiders of the business. So in order to manage risk, we have to diversify our portfolio. For me, there is no right or wrong strategy with regards to diversification. One just has to pick a strategy that most suits his or her personality and preference. Others believe that you should have just a few great companies and concentrate your money in those businesses. But since I am a very conservative person, I like to have 10 to 15 great stocks and then distribute my money evenly across these businesses. And even if I may get it wrong now and then once in a while, I will still make money from the other businesses, meaning that my portfolio will continue to grow over time. So I am now going to share with you the rules that I follow when constructing and managing my portfolio of companies. Remember, our aim is to build a low risk, high return portfolio. Number 1, I spread my capital across a portfolio of 10 to 15 great stocks. Then there are other people who will go up to 30 stocks or even more. But the problem with going over 30 stocks is that quality begins to decline, and it also becomes difficult to track and manage these investments. And that is when one begins to make mistakes and start losing money. So I always keep my portfolio within 10 to 15 stocks. Number 2, my portfolio is diversified among 3 countries, namely US, China, and South Africa. The US takes up approximately 67% of my portfolio, China 22%, South Africa 11%. I also spread my positions across sectors and categories we spoke about in previous lessons, such as growth, predictable, dividend, speculative, and so on. As far as possible, I divide my capital evenly among the core long-term investments. For example, if I have 10 core stocks in a 10,000 Rand portfolio, then each stock would have a value of 1,000 Rands. This is not always possible to maintain at all times, but that is the long-term target. I do not own any speculative or deep value stocks, but if I were to invest in such companies, I would only allocate a third of a normal position or less because these stocks are more risky. For example, if my normal allocation is 1,000 Rands per stock, then I will only invest 333 Rands to each speculative or deep value stock. But like I said in previous lessons, I don't invest in these types of companies. Number 5, so when would I add shares of any particular stock? 1, when that stock is undervalued, meaning that its price is below its intrinsic value. Number 2, the price has retraced down to a level of support. And number 3, that stock has not yet reached full position or full allocation in my portfolio. But once a stock has reached its full allocation, I tend not to add any more shares unless that stock is selling at a great discount of 40 to 50%. At those levels, it becomes very difficult to ignore. In terms of money allocation, I always try to keep my portfolio as balanced as possible, where each stock eventually makes up an equal percentage of my total capital. Please note that it takes time to balance a portfolio because the target stocks will not go on sale at the same time. They will not reach buy levels at the same time. So we take this as a long-term plan. For example, let's say at the beginning of each year, I have $120,000 to invest in my portfolio of 10 stocks. So, which means that each stock will have a 10% allocation of that $120,000, which is roughly $12,000 per stock. For example, take Adobe. If my buy target for Adobe is $621, then it means that for that particular year, when Adobe reaches that buy target of $621, I will only buy 19 shares of Adobe, which would be equal to 10% allocation. Similarly for Microsoft, if Microsoft, my target buy point is $379, so when Microsoft hits that price of 379, so I will only buy 32 shares of Microsoft, which equates to a 10% allocation. And I will do the same for the other stocks. I hope you guys understand that.